Getting a little closer to getting back on track, I want to introduce the next speaker. And again, Joe Kraft was literally on the top of the list as far as speakers that we need, because we talked to a lot of prospective clients and they ask about sales taxes. And there's very few CPAs, accountants that really understand this space. And actually I know of a couple. Joe's the best, absolutely the best, has a fantastic reputation in the industry, very involved in the industry, and he's just a great guy to work with. I've worked with him before. I was actually on the phone when there was a client that had an issue, and to hear Joe work through the problem and solve that problem for that client, he just has a way about making the complex very simple. Very happy that he's here, and this is a very valuable and important subject. Some people gloss over the tax issue, but it's a big deal. And so Joe, come on up here and teach these people about some stuff.
Thank you, Kevin. Thanks to Jay and Kevin for putting this event on and inviting me. I'm pleased to be here to share this with you all today. I'm going to talk for the next 3 or 4 hours about taxes. No, I'm not. Just kidding. Hopefully I won't fall asleep in my presentation. But it's pretty dry stuff. But anyway, the first thing that I usually talk to people about when they come to me as their CPA advisor is what type of business entity are you going to have to operate your business? Generally, nowadays, I recommend the LLC because the corporation and the LLC both give you legal protection. The LLC is the only entity that the IRS permits you to choose how you wish to be taxed. So you can be taxed as a C Corp if you elect to do so. You can be taxed as an S Corp, or you can be taxed as just what the general default treatment is for an LLC, which is either a partnership if there's 2 or more owners, or what's called a disregarded entity if it's just one owner. So, you know, because of that flexibility, usually the LLC is the way to go. So you establish your entity. You make a decision about how you wish to be taxed. You've got 75 days from the date that you establish the entity to make that choice. There are provisions that you can do that retroactively if you miss the 75 days. You need to get a federal tax ID number if you don't already have one. You can do that on the IRS website, which is irs.gov. It's free. It takes about 10 minutes, and they'll give you the number right on the screen. You need to register with your state's your home state's tax department for whatever taxes you're subject to. Generally, those will be some form of corporate income or franchise tax, withholding taxes if you have employees, unemployment taxes if you have employees. There may be some local city or county business licenses. There's 1 or 2 states that, like Nevada's one, that actually has a business license as well. So you need to get registered for whatever your home state's taxes are. And then we'll talk about, okay, now what taxes may you be subject to? And so we're going to go through sales taxes. We're going to go through unclaimed property. We're going to go through 1099s and state information returns. And we'll talk about audits, we'll talk about accounting considerations and software choices, and then we'll take some questions. So with the sales tax, you know, it has a lot of different names depending on what jurisdiction you're in. Some places call it a sales tax. Some places refer to it as a seller's use tax. There's a few that call it a retailer occupational tax, but basically, it's a tax based on the transaction, whatever you're selling. Now the responsibility is to collect the tax is on the retailer, okay? And the retailer is defined differently in different jurisdictions. That's the thing that I think when you are finished hearing my presentation, you're going to realize that there's no uniformity about any of the things that I'm talking about, and it drives people crazy. There has been an effort to streamline and make more uniform the sales tax area. It's called the Streamlined Sales Tax Project. There's about 20 states that participate in that. That's totally voluntary on your part if you wish to sign up for it. But these 20 states that have entered into this streamlined sales tax project, basically they are establishing some uniformity in the methods of filing, what happens in an audit, what the definitions are of things that are taxable, things that are non-taxable. So hopefully that will progress as things move along. First thing with respect to sales tax that we should talk about is who is subject to sales tax. Okay, now there are different standards based on the different jurisdictions. Kevin referred, or maybe it was Jay, referred to Nexus the other day. Nexus basically is what ties a company to a jurisdiction. And there are 6 states presently that take the position that if you have independent sellers working in that state, then you're subject to their sales tax. And they won't even allow the rep to sign up to remit and pay the sales taxes. They basically force the company to do that. And I'm going to throw a lot of statistics at you today, so I've got to look at my notes. Those 6 states are Kansas, Michigan, Missouri, Texas, Utah, and Washington. Kansas, Michigan, Missouri, Texas, Utah, and Washington. And basically, those states are very aggressive, and beside your home state, those are probably the first states that I would look at registering for sales tax. Now, there are a couple others that are kind of on the watch list, I guess you would say, California and Kentucky. They have the same standard of nexus where if you have independent sellers in their jurisdiction, then they expect the company to collect and remit the sales taxes. But they're not as aggressive. Now, California is aggressive, but they don't have the rule like the first 6 states where they won't even allow the independent representatives to collect it. Generally speaking, it's the independent representative's responsibility to collect and remit the sales tax. However, the states, the other states that I didn't just mention, encourage all companies that are in the direct selling industry to voluntarily collect and remit the sales taxes. And there are a number of benefits to that, okay? And those benefits are that you are basically controlling and ensuring that all the laws are being complied with. You're reducing the burden on your independent sellers. You've got some time value money because as you collect the sales tax, you've got some float on that money because typically you don't have to turn it over until sometimes much later, sometimes not even until the end of the year. Some states will permit, there's about 25 states and several local jurisdictions that allow you to keep what's called a deductive vendor's compensation fee, which is basically their way of saying, hey, thanks for doing this for us. You can keep so much of your sales tax. Now, for small companies, it's pennies on the dollar. That's not nearly enough, but for very large companies, it can become a profit center for them because their vendor's compensation will exceed whatever their costs are of complying with all of these rules. Another benefit is, and I think Kevin's going to talk about this later, compliance with the Sarbanes-Oxley Act. Now, typically this applies to public companies, but if you ever were to have to have an audit, like by an independent CPA, there are certain things that they go through from a risk assessment when they're looking at your internal controls to make sure that you're complying with all the laws. And so this makes you compliant with that aspect of the Sarbanes-Oxley. Another one is just having the kind of creating the culture of, you know, between the company and the seller and the tax authorities that, hey, you know, we're in compliance and we're trying to do the